Imagine the worst investor in the entire history of financial markets. Not someone who picked a few bad stocks, not someone who sold during a minor dip. I mean someone with catastrophically bad timing. A person who, without fail, invested every single dollar at the absolute peak of the market, right before every major crash, every single time. 1973, peak. Right before the oil crisis crash. 1987, peak, right before Black Monday. 2000, peak, right before the dot-com bubble burst. 2007, peak, right before the global financial crisis. 2020, peak, right before the COVID crash. Every single time. You'd assume this person is completely financially ruined, right? You'd assume that after a lifetime of the worst possible...
Let me introduce you to three people. Same starting point, same income, same time horizon. Very different approaches. First, meet Petra Perfect. Petra has an almost supernatural ability to time the market. Every single year, she waits patiently, reads the charts, studies the macro environment, and invests at the absolute lowest point of the year. The perfect entry, every time. Then there's Warren Waiting. Warren is smart, cautious. He reads the news obsessively and always feels like the market is too expensive right now. So he waits and waits and waits. His money sits in cash, earning minimal interest, while he looks for the right moment that never quite arrives. And finally, meet Betty Bad Timing. Betty has one rule: invest consistently no matter what. The problem? She always seems to pick the worst possible moment. Every lump sum she invests lands right at the market peak, right before a major crash. Her timing is so bad, it almost seems intentional. These three people represent real choices that real investors make every single day. And the results, backed by more than 2 decades of data, are going to completely change how you think about investing. But first, here's the question that haunts almost every investor. From complete beginners to people who've been in the market for decades, is right now a good time to invest? And honestly, it's a reasonable question. When you look at a stock market chart, every peak looks obvious in hindsight. You can see exactly where the crashes happened. You can see where the smart money should have waited. So the logic feels completely rational. If I can just avoid buying at the top, I'll do better. If I wait for a dip, a correction, a crash, something, I'll get in at a better price and maximize my returns. This feels like common sense. It feels like discipline. It feels like the intelligent investor's approach. Think of it like this. If you knew that a jacket you wanted was going on sale next week, you'd wait to buy it, right? Why pay full price when you could pay less for the exact same thing? That logic works perfectly for jackets, for groceries, for airline tickets. But for the stock market, the data tells a completely different story. And this is where things... In a fascinating study by Charles Schwab, researchers analyzed a 20-year period from 2003 to 2022. They tracked 5 different hypothetical investors, each with a different strategy, each investing $2,000 per year into the S&P 500. The investors were the perfect timer, always invested at the annual low. The immediate investor invested on the first day of every year, no matter what. The dollar-cost averager split investments monthly throughout the year. The bad timer always invested at the annual high. That's our Betty. The cash hoarder never invested, kept everything in cash. Now, after 20 years, what were the results? The perfect timer ended up with $151,391. The immediate investor? $135,471. The dollar-cost averager? $134,856. And Betty, the catastrophically bad timer, the person who bought at every single peak right before every crash? $121,171. That feels completely backwards. How is this possible? Betty invested at the worst possible moment, every single time, and she still ended up with over $120,000. She still nearly doubled the person who never invested at all, who ended the same 20 years with just $44,438 in cash savings. And here's the part that should really stop you in your tracks.
So if the data is this clear, if study after study shows that staying invested beats waiting, why do so many investors still sit on the sideline? Why does Warren waiting feel so rational, even when the evidence says he's wrong? The answer is psychology, specifically two cognitive biases that are deeply hardwired into how human brains process risk. The first is loss aversion. Research by psychologists Daniel Kahneman and Amos Tversky found that humans feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. Losing $1,000 feels about twice as bad as gaining $1,000 feels good. This is not a character flaw. It's evolutionary. For most of human history, avoiding loss was more important for survival than pursuing gain. But in the context of investing, this bias is catastrophic because every time the market drops, even temporarily, it feels like a disaster. It activates the same emotional response as a genuine threat. And so we do the rational feeling, emotionally driven thing. We wait. We hold. We don't buy more. We might even sell.
So what do you actually do with this information? The answer is simpler than most people expect. And that simplicity is exactly why so many people don't trust it. Step 1. Start investing now. Not when the market feels right, not after the next earnings season, not after the election. Now. The Charles Schwab data shows that even the worst possible timing over 20 years dramatically outperformed never investing at all. The longer you wait for the perfect moment, the more certain it is that the perfect moment has already passed. Step 2. Use dollar cost averaging as your default system. Set a fixed amount, whatever fits your financial situation, and invest it automatically on a regular schedule. Monthly works well for most people. You don't need to think about market levels. You don't need to check the news. You remove the emotional decision entirely. Some months you'll buy at a relative high. Some months at a relative low. Now, and this is important, I want to be honest about what this data does and does not tell you. The Charles Schwab study analyzed the S&P 500, which is a U.S.-focused index. The U.S. market has been, by almost any measure, the strongest performing major market of the last century. The results for an investor in a different market or in a globally diversified index may look different. Researchers at T. Rowe Price have noted that the MSCI All-Country World Index includes over 2,800 companies across 47 countries. An S&P 500 investor, by contrast, has roughly 41% of their portfolio concentrated in just the technology sector, according to Rockefeller Capital Management. That level of concentration has delivered extraordinary returns in the past 2 decades, but concentration risk is real, and past performance does not guarantee future results. This also does not mean timing is completely irrelevant in every context. For very large lump sum investments, the next time you find yourself thinking, I'll wait until the market dips, I want you to remember Betty. Remember that the unluckiest investor in history, the one who bought at every single peak, right before every single crash, still ended up with over $120,000, still built real, meaningful wealth, still beat the person who did nothing. The market is not a puzzle to be solved with perfect timing. It is a vehicle that rewards the people who simply stay on board long enough. If this changed how you think about market timing, I'd genuinely love to hear your thoughts in the comments below. Are you a Warren waiting, or are you already a Betty, investing consistently regardless of what the market is doing? I already have several videos on dollar cost averaging and index fund investing on this channel. I'd recommend watching those next if you want to go deeper on the practical side of what we covered today. If you found this useful, a like helps this reach other investors who need to hear it. And if you're not subscribed yet, now is a pretty good time to start. Not financial advice, but definitely worth thinking about. See you in the next one.